Hello, my name is David Kinsey, and I am the Director of International Wealth Management at Creative Planning International. And today I'm going to walk through 4 questions for U.S. expats investing in IRAs and Roth IRAs. The first question is, do you qualify as an American expat to make an IRA contribution? And generally the answer to that is yes. Many Americans abroad believe they are not eligible to make IRA contributions, but that is not correct. An American is eligible to contribute to an IRA from earned income, even if that earned income is foreign earned income. The biggest difference, however, as an American abroad, is you have to consider the calculation that determines whether or not you're qualified to make that contribution or not. And it is a little bit different than it is in the United States, primarily because we have to understand that Americans abroad are very commonly employing on their U.S. tax returns something known as the foreign earned income exclusion and or the foreign housing exclusion. This allows them to exclude substantial portions of their earned income from U.S. taxation if that earned income was made outside of the United States. To make an IRA contribution, you need to have income that exceeds those exclusion amounts. You must have non-excluded earned income from which to make an IRA contribution. And if your income is below those exclusion amounts, you'll have 0 non-excluded earned income and you cannot make an IRA contribution. But for higher income Americans working abroad whose income exceeds those exclusions, they are perfectly eligible under the U.S. rules to go ahead and make an IRA contribution, even from foreign sourced earned income. Whether or not you want to make an IRA contribution, however, under these circumstances, is different than being eligible to make the contribution itself. Whether or not it makes sense from a tax and finance point of view is primarily driven by considerations about the local country of tax implications of making that IRA contribution. So let's walk through exactly what I'm talking about. Aside from understanding the U.S. rules, we also have to understand how that IRA contribution will be treated in the country of residence for the American expat. For most Americans who are living in high tax countries, what they will find is that after having paid their local country of residence taxes and taking the foreign earned income exclusion and a credit for those taxes paid, they will have completely eliminated their U.S. tax liability. If they have no U.S. tax liability, then whether or not they want to make an IRA contribution will depend upon whether or not they're going to get a tax benefit in the country in which they reside. And if the country in which they reside will not give them a tax benefit, as we'll see, it will not make sense to make that IRA contribution. Let's look at the example of Germany that fits this scenario quite well. Germany is a high tax country. Americans living in Germany will find generally that their taxes paid and their foreign earned income exclusions will completely eliminate their U.S. tax liability for the income that they've earned in Germany. Under these circumstances, it will only make sense to make that IRA contribution if Germany will give you a tax benefit for doing so. But Germany generally will not permit a tax deduction for contributions made to a U.S. IRA account. Therefore, there will be no tax benefit in Germany. In this scenario, we're getting a tax benefit neither in the U.S. nor in Germany for making this IRA contribution, and therefore, generally, it does not make sense to make the IRA contribution. But we must take the analysis one step further and look at what happens if we still go ahead and make the IRA contribution. In this case, we are going to fall into the trap of ultimately double taxing ourselves because we will take an IRA contribution that generates no tax benefit in either the US or Germany. We will put it into the IRA. We will essentially be recycling an after-tax income item back into the IRA, And when we go in retirement and withdraw that contribution, it will be taxed again a second time, and we will have effectively double taxed ourselves. This is unfortunately an all too common scenario and outcome that we see among American expats who are contributing when in fact it does not make sense. So this raises the third question that I want to address today. How does your country of residence tax U.S. IRA contributions? Now, this question needs to be answered on a country-by-country basis. We've now talked through the scenario of Germany, where generally it does not make sense for an American to make an IRA contribution, but there are other countries where it does. Let's walk through the example of Switzerland. Switzerland, like Germany, is also a high-tax jurisdiction, but there, the double tax treaty that Switzerland has with the U.S. allows for the deductibility from Swiss taxable income of that IRA contribution. Therefore, in this scenario, you are able to get a benefit on your Swiss tax, reduce your Swiss tax liability with the IRA contribution. And therefore, it now generally makes sense to make that IRA contribution. Furthermore, in Switzerland, assets held within an IRA are exempt from the Swiss wealth tax, giving further reason to accumulate assets in an IRA account if you are an American in Switzerland. Okay, let's now look at the example of Hong Kong. Hong Kong is another case where generally for higher income Americans, it makes sense to make an IRA contribution, but for different reasons. In this scenario, Hong Kong is a low tax jurisdiction. Americans in Hong Kong generally will not be able to completely eliminate their U.S. tax liability because the credits available from Hong Kong taxes paid will not be enough to offset the earned income of higher earning Americans. However, they can still make that IRA contribution if they have income that exceeds the exclusion amount, as we talked about earlier. And if they do, they will be reducing the size of their U.S. tax liability, which they do have in this case because they are in a low tax jurisdiction. Furthermore, making that IRA contribution will have no adverse or tax consequences in Hong Kong, and therefore, generally, making an IRA contribution works for higher income Americans. It will reduce the current U.S. tax liability and generally has the same effect as if you were back in the United States. So you can see through these examples that the decision to make the IRA contribution ultimately comes down to understanding whether or not you're eligible in the U.S. to make the contribution, and then understanding how that contribution will be treated in the country in which you reside. It's very specific to the country, the treaties that prevail with respect to each individual country. Now let's address the fourth question that we want to look at here, which is, does it make sense for a Roth conversion to do a Roth conversion for Americans abroad? Okay, the first question that we have to analyze when we consider converting IRA or 401k assets to a Roth IRA is, how will the distributions from that Roth IRA ultimately be treated in the country in which you reside when you expect to withdraw that money from the Roth IRAs? And if you expect to be living abroad at that time, you have to ask, how will the country of residence at that point treat those distributions? Many countries will not respect the principle that a Roth IRA distribution is tax-free. It is not explicitly recognized in the treaty. In other countries, it is explicitly recognized in the double tax treaty that the U.S. may have with those countries. In other countries, there may be no tax treaty, but certain countries may not tax distributions from U.S. retirement accounts. So again, we are very much in a scenario where this decision is dependent upon local country of residence tax treatment considerations of that conversion. But if the Roth will be acknowledged and treated as tax-free, and that could be because there's a treaty provision, as in the case of France or the UK or Canada, that allows IRAs to be treated as tax-free, or if you're in a country, say, perhaps Costa Rica or Hong Kong, where U.S. IRA distributions would not be taxed in any case, whether they're traditional or Roth, then the Roth distribution, or I should say the Roth conversion, is an option you want to consider. And now we default back to the decision framed purely in the same terms it would be as if you were back in the United States. And there, the decision depends upon comparing your current tax rates to your tax rates in retirement. And generally, the rule is if you expect your tax rates in retirement to be as high or higher than they are now, and again, make sure you're looking at both the U.S. tax rate and your local country of residence tax rate on these distributions, then you want to go ahead and make the Roth conversion. So this is why we very frequently recommend that people in their years before 72, when they begin getting mandatory distributions from their IRAs and their Social Security, and they've already, and in those years in their 60s, typically when they've stopped working but are not getting investment or they're not getting retirement income, their tax rate goes way down. Their tax rate in those years is going to be lower than their tax rates in their 70s when they start getting all of this retirement income. That is a perfect time to do a Roth conversion. And if it works in the country where you reside, it makes sense in an expat scenario. So these are the kinds of tax strategies, financial planning strategies that we are looking at and working on with our clients all around the world every day here at Creative Planning International. This underscores the complexity of making these decisions with respect to our retirement and financial plans, given the complexity of cross-border taxation for Americans abroad. Thank you.